Welcome to another episode of the Financial Armor Show. My name is Brad Cooper, your host and also CEO of Cooper Financial Investments LLC. And as always, I want to welcome my wonderful, amazing co-host Tony Shore. How you doing, Tony?
I'm doing great, Brad. We were talking before the show. I'm definitely not as busy as you are. You've been really busy, and I know this time of year gets crazy, right?
Yes, it does.
Yeah, but you love meeting with people, and you like to stay busy and talking to people, helping them with their finances. That's your passion. And but I do know you've been meeting with a lot of folks, talking to people who listen to the show. So that's fantastic. I really think that's great, Brad, that you've been doing that. I've been good spending time with family. How about you? What's going on there? Just meeting with folks,
Uh,
right?
Yeah, just doing great. You're right, Tony. And like we were talking about before the show, just how busy, it seems like everyone is. And
Yeah.
and also, every one of us has exposure just to life and things happening. I mentioned, I think a few shows ago, of a lot of health issues my wife's been going through and trying to get a new kidney. And I share that with you because as busy as we are, and my passion and love of meeting with people is therapy for me. And I share that with our new appointments with our clients. And as I'm meeting with them and helping them out, they're helping me out. They're pouring into me as much. I learn more, Tony, from our clients than they probably learn from us. But at the end of the day, I look back and say, wow, I forget about all the problems, the stress, the everyday life that we all go through. And that's what keeps me going after 30 years and hopefully, God willing, another 30 years. Because at this point in my career, Tony, this is not work. It's just a blessing to be able to do what I'm doing.
Yeah. Yeah, and I know I've been praying for your wife's
Well,
situation
thank
there,
you.
and I know that you're right there by her side trying to help her with that, and there's been a lot of meetings, even the Mayo Clinic, so, I
Yes.
hope that goes well, and we'll be praying for you,
Well, thank you. Thank you so much.
praying for her situation there.
Yes. Well, God's a good God and He's in
Yeah.
control. Well, let's talk about the topic, which it seems like on every show, Tony, we come up with that nasty T word. What's that nasty T word?
Well, I hope it's not Tony, because
It's
that would be very hurtful, Brad, if you said Tony. No,
no,
it's
the,
taxes,
the
right?
worst one. That
Yeah,
Tony may
taxes.
be, in the top 10, but taxes.
Taxes are that's the terrible tease right
Right.
there,
Well,
taxes.
what we're going to talk about is taxes and your retirement, and really just talk about, the impact and different types of taxes
Mhm.
that will impact you and your retirement plan, and something that you should be watching out for, be very cautious with. That's probably the majority of our conversation every day with our clients and new appointments, is the topic of taxes. And we get our strategic partners involved, our tax experts, they get involved with our clients. And very important topic of what we talk about on a daily basis. And, the article I just read here recently, how 13 types of retirement income get taxed. Pretty
Oh,
depressing, right?
wow.
That came from
Yeah.
Kiplinger,
Yeah,
an
people think
article.
they're not gonna have to worry about taxes in retirement, but retirement taxes, you have to plan for taxes in retirement and try to minimize that, right?
Absolutely. Just 2 days ago, Tony had a person come in that we're working with. He brought in the last 3 years of tax returns. He's been retired for 3 years. And of course, his money, like most of our clients' money and new people we're sitting down with, the majority of their portfolio and retirement nest egg is in either 401ks, IRAs, 403bs, taxable accounts. And he made a comment which just, kind of mirrored what you just said. He said, Brad, I put into my 401k for the last 25, 30 years. I was told by everyone that when I got to retirement, I would not have to worry about paying taxes. Look at my tax returns. The last 3 years I've been retired, every year I'm paying more and more taxes. And then I went on to say, well,
Yep.
I got some worse news for you.
Uh-oh.
Right now, we are at about a 75 to a 100-year low when it comes to federal income taxes. Come 2026 and in the future beyond that, taxes are going to increase. So that's why we use this conversation and talk a lot about the one of the biggest risks, in my opinions, is future taxation.
Yeah. Yeah. I mean, you talk about the three punches you can take in retirement, and healthcare is a big one.
Right.
Market risk is
Yes.
another one, and taxes is probably healthcare and taxes are the two biggest
Oh,
risks
it
out
is.
there in your retirement. But you can minimize that. You can do things now if you start early enough and work with somebody like yourself from an early enough point. You can do a lot to minimize your tax burden in retirement, right?
Absolutely. You just want to be proactive, but more importantly, what I found, Tony, in my industry, and Ed Slott, if you're not familiar with Ed Slott, he's one of the most respectable, most foremost experts in the United States when it comes to taxes. And we've been very blessed to be part of his group. He has handpicked about 300 advisors nationwide, and we're one of those 300, which means that we have access to him and his staff of former IRS attorneys, estate planning attorneys, tax attorneys to get advice for our clients. And I mention Ed Slott's name because every time I'm in a meeting with him, which will be the next one next month, he always talks about 99% of our industry does not talk about the tax risk that we're going to be facing. And why is that? Number one, we don't get paid. We cannot do tax planning personally. We get our team involved. We are not compensated, neither is our industry. So, therefore, that's why a lot of our industry is not bringing up this discussion. And then, not only that, if they are bringing it up, they're not holding your hand. They're not walking you through the process because a lot of our clients we're working with, it's going to take 3, 4, 5 years to take them from taxable accounts to tax-free accounts. And that relies on a good financial advisor, a good tax person, all working together to make sure you achieve success.
Yeah. Yeah, and I think that's really important. You have to work with a tax professional, and I know that your team there, you help your clients with this, and you have to have a financial advisor who's quarterbacking and has the big picture and
Right.
takes that holistic approach like your team does there. And you work alongside tax professionals to help your clients. But it makes a huge difference because there are so many strategies that you can utilize to minimize your taxes in retirement. You don't want to, like you mentioned, Ed Slott, his book, The Ticking Tax Time Bomb,
Right.
are all these tax deferred retirement accounts, and they can even affect your social security. You know how much of that is taxed. If you take withdrawals from these accounts that are taxable, then your social security, that's income, and it could put you into a higher bracket or affect things like how much you have to pay for Medicare, or there's a lot of factors, aren't there?
Absolutely. You hit on all of them. And that's what the majority of Americans do not realize. And I just shared with a person I talked to a couple days ago, I said, I'm very excited because about 67% of our clients, Tony, in the next 3, 4, 5 years will be in a 0% tax bracket
Wow,
for the rest of their
zero.
life. Zero. And what that means also, you mentioned Social Security.
Yeah.
There's a way of not having to pay taxes on your Social Security, but the majority of Americans I'm finding do not know that. So, very exciting. And not only enjoying the rest of your life in a 0% tax bracket, but also passing on a legacy to your children, your grandchildren, and allowing that to be tax free is a lot of our conversation. And a lot of it is just common sense money principles, but it's not brought up enough from my industry. Shame on us. But also, at the end of the day, and I shared this with you, I think off air, when it comes to healthcare and dealing with specialists, sometimes you don't know what you don't know.
Right.
And I'm finding out that's the majority of people I'm sitting down with. And I'm talking very successful careers, high net worth. They just were never given the information, the education, so they don't know what they don't know.
Yeah.
And it's surprising because we talk about this, on a weekly basis,
Yeah.
Tony. But going back to several types of retirement income and how they get taxed, I just had this question last week, from a person. We're talking about their 401k, and they had a couple IRAs,
Hmm.
and they knew the IRAs were taxed. But their traditional 401k, not 401k Roth, but 401k that they put into, they were kind of surprised when I talked about 100% of that money is taxable.
Yeah.
So those two areas. Then, of course, if you have what's called tax deferred accounts, I like to call them tax friendly accounts. They're not tax free, but what is a tax deferred account? This would be an account that you put money into, and I'm just going to use one of many examples, a fixed indexed annuity. Let's say you put $100,000 in a fixed indexed annuity, and let's say over the next 12 months it grows to 110,000, and you don't take any money out of that. That $10,000 worth of earnings that is reinvested, you will not get a 1099.
Hmm.
Now, what if you pull out part of the interest or all of the interest? You will get taxed in a 1099 on the interest and earnings only. So that's what's called a tax deferred account, which we use a lot in addition to tax free accounts to shrink the taxable, income that you may face in the future.
Yeah. Yeah. So, in other words, there are accounts that they grow tax free, and all the money, the earnings, and everything come out tax free. As you mentioned, Roths, a Roth IRA or Roth 401k. However, there are also accounts where you put the money in, and it grows. When you take it out, you just have to pay tax on the interest, not the principal.
That is correct. Let me give you a story, which a really good friend and client that I've gone to church with for years. She lost her husband, maybe 3, 4 years ago, and they were very successful. They had lots of rental income, pensions, Social Security, and the husband who passed away did an amazing job with investing for the past 40, 50 years. So when I sat down and we were taking a look at all her accounts, of course, all the wealth that they accumulated, she did not need. Her goal was to pass it on to her children, her grandchildren, her nieces, her nephews, because she had sufficient monthly income from rental income and pensions and Social Security. So, one account in particular, there was $1 million in this account before she became a client. And the year before, the market was good. She made over $100,000, Tony. Pretty good,
Wow.
pretty good, right?
Yeah.
Got got reinvested, but the only problem, because of the type of brokerage account it was in, she received a 1099 for $100,000. So you may
Oh, no.
so you may be thinking, well, that's not sad, Brad. That's a good problem to have, 100,000. But here's what it did: that $100,000 was added to her Social Security, added to her pension, added to her rental income. And as a result, it threw her in the highest tax bracket possible. So she ended up giving away over 40% of her income to the IRS. So using a tax deferred or tax friendly account, like we just talked about, the following year, since that million, or actually 1.1 million now, was moved over to a tax deferred account, the market did good that year. It did over 12%. So she's now up another $100,000 to $150,000. Since she did not take that money out, she did not get a 1099. So now in her lifetime, that's helping her. But you hit it right on. Down the road, let's say once she passes, that goes on to her estate, to her children, then they will be responsible for paying taxes on the earnings.
Hmm. Okay. It is good that you explain that because people don't understand how this works. I mean, it really
No,
is. It's important. So the Roth, there are a couple of there's a caveat with a Roth, though, right? I mean, uh, there are income limits to who can contribute to a Roth. Going back to the Roth,
correct.
that's one caveat. And what else about a Roth do we need to know? Like,
Great questions. And here's a common question I get on a weekly basis, Tony, is, number one, I want to contribute to a Roth. So there's special guidelines for that. Number
sure,
one, you have to have earned income. Earned income is if you're working is the primary source. Social Security does not count as earned income. So if you're working and you want to contribute, based on your age, I know right now in 2024, if you're over 50 or older, you can contribute, you and your spouse, if you're married, up to $8,000 each. Now, the caveat or the area that would mess that up is income. There are income restrictions.
sure.
So I believe joint, they change this every year, I believe is around 160 to 170. It could be a little bit higher. But if you make too much money together as a family, you're not eligible to contribute to a Roth IRA.
Okay.
However, that's contributing on an annual basis. Then we've talked a lot about, Tony, in previous shows, conversions.
Roth
Roth
conversion.
IRA conversions,
Converting
correct.
your traditional IRA or money from a 401k into a Roth, right?
That's correct.
A
So
Roth IRA.
when you're looking at Roth conversions, the rules are completely different. There's no income restrictions and there's no limit to what you can convert. Let's say you had $1 million IRA and you wanted to convert that to a Roth IRA in 1 year, you can do so. Now, I would not advise you to do that unless you
No, not
consult
all at once, especially.
unless until you consult with a financial planner and a tax expert.
Yes, you
So
gotta talk
please do
about
not do
taxes
that
before you do
because there's
that.
a strategic way of doing that. But that's what's called a Roth conversion. So there's no limitations with conversions versus if you're contributing on an annual basis, which a lot of our clients are who are still working, contributing to a Roth on an annual basis.
And then accessibility to the Roth, there's a couple of caveats there, right? You have to be 59 and a half, I assume, like all
Right.
retirement accounts before you can take money out of a Roth. And what's the other one?
59 and a half is the age,
Yep,
or there are exceptions for, I believe, emergencies,
sure,
hardships, college, very limited on what you can take
sure.
out. But what happens if you do have to take that out? If you do take out money out of a Roth IRA, out of a traditional IRA, or even an annuity, before you hit the age of 59 and a half, the IRS will hit you with a 10% penalty.
Yikes. So don't do that.
Don't do
Plus,
that.
why would you do that? Because that money is for retirement, right?
That's
You
right.
shouldn't touch money in your retirement accounts because before 59 and a half, I mean, unless you retired early, but even so, if you put it in these accounts, you want it to grow until you retire.
Absolutely. And I may have mentioned this previously, Tony, but if not, I'm going to repeat this because I had this conversation again recently. Whether you're younger than 59 and a half or older than 59 and a half in retirement, I'm encouraging a lot, not everyone, but a lot of our clients, especially if your house is paid off or you have a lot of equity. It seems like because of the market the last several years throughout the United States, especially here in Arizona, everyone's homes have appreciated drastically. What we're recommending is take out a home equity line of credit. Now, open disclosure, we do not do these. We do not get compensated on these. Go to a bank, go to a credit union, but open up a line of credit. It may cost a little bit of money to open that up and just have it sit there. And the reason why is we're all going to come across times when financial emergencies come up, whether it's for us personally, could be health bills, it could be children. And when that happens is what I have found in previous years is clients will call up, Brad, I need to get my hands on $75,000. And no problem, we can take it out of your accounts. But if that's IRA money, guess what you have to pay? Taxes.
Yeah.
And it may make sense to do that. Or if it doesn't, or because maybe they've taken too much out already and converted in that given year, if they have a line of credit that's wide open, no balance on it, there's no cost on a monthly basis, they could immediately pull money out of their line of credit, get that normally within the same day, transfer that over to their account, and have that money available. So that's some of the advice we're giving to some of our clients. It does take discipline. I wouldn't recommend it to a younger person
No.
because it could be devastating if it's misused.
Yeah. Yeah, it can be. So those are words to the wise. Now, we're talking about taxes and your retirement, and that's important. And I know a lot of our listeners are going to have questions, Brad. So let's take a moment before we continue and let our listeners know how they can get a hold of you.
Absolutely. If you have questions about any of topics that we've talked about, you can visit our website, financialarmorshow.com. Again, that's financialarmorshow.com. You can fill out a form and we will be contacted. Also, you get an opportunity to look at previous shows, or you can call us Monday through Friday at 888-390-5277. Again, that's toll free, 888-390-5277. And we will answer any questions you have. Or if you just want to come in and have a cup of coffee and get answers to a lot of questions you have from our team, from our CPA team, our attorneys, we're here for you. And I can promise you that when you do leave, you will be leaving with a lot of information you may not already know.
Yeah. Yeah, and it's smart to set up that consultation. Brad, I know you love to hear from the listeners out there and the
Right.
viewers, so that's awesome. Now, what else can you tell us about taxes and our retirement? Where do you want to go next?
Well, let's talk about pensions, which we don't um, hear about as much, nowadays. Like for you, Tony, I'm sure you're probably going to get about a $50,000 a month pension when you retire. Unlike me, which
Goose
is
egg.
zero. Oh,
Yeah.
zero.
Yeah.
Okay. Well, pensions used to be very popular
Yeah.
years ago, and a lot
I
of our
wish I had a
clients.
pension.
Oh, me too. A lot, a lot of our clients have pensions,
Sure.
and
Maybe they work for the government. The government's really the only place you can still get a pension nowadays,
right,
for the most part.
corporations used to, but not
Yeah.
anymore.
No.
They have forced people to save on their own and use them 401ks. But pensions are funded with pre-tax money. So if you receive a pension, or if you're going to receive a pension, you will have to pay taxes on that pension. And both government and private pensions are taxed at the ordinary income tax rate.
Sure.
So not capital gains, but ordinary. So that's one thing to be cautious with.
Sure.
Another topic in tax we talk about a lot is capital gains.
Okay. How
So
does that work?
So, good example, the best example of that is if you have gains at least a year older on stocks, bonds, mutual funds. Basically, once you liquidate those accounts, you will be subject to capital gains and have to pay taxes at the year that you liquidate, or maybe liquidate and move into another portfolio. Right now, the going rate is 15 to 20%, which is not bad. It's really very low. And part of that, along with the federal income tax rates being so low, is all what Trump put in place back in 2017, 2018. But keep in mind, all that's going to expire and sunset December 31st of 2025. So there's been talks, really 2 years ago, Congress almost passed a law where the capital gains tax was going to increase from 20 to 43%.
Yeah.
And
I remember
now
hearing about that.
a lot of our tax experts are talking about what they're seeing by the year 2030, and they really all believe that we're going to be seeing probably capital gains close to 40%. Now, that, of course, impacts mutual funds, stocks, bonds, long-term gains. But also there's a lot of talk, Tony, about real estate. Let's say, for an example, that your parents pass away, you inherit the house. Right now, there's a step-up basis where there's no tax liability in most cases, just to keep things simple. But there's been several states, including California recently, that is trying and it gained traction. I don't think it passed, where when you sell your house, they're going to go back. Well, Tony, you bought this house 25 years ago for 100,000 and now it's worth $1 million. So your gain was $900,000. Whatever the capital gains tax is on that gain would be what you would have to pay if these states or if the laws change. They have not yet, but there has been talk about that.
Yikes. Yeah, I
Scary,
hope they don't take away the step up in basis. I really don't.
right? And that applies also to stocks. I know I just lost my father about a year ago. And any stocks that he had that we inherited basically was a step up basis. So let's say he bought the stock years ago and he had $10,000 worth of stock, but now it's worth 100,000. Basically, now my new cost basis would be 100,000, and I would not have to pay taxes on the difference of $90,000 in this example because of the step up basis.
Yeah. Yeah. Makes sense. Yeah. That's really important. Now we're almost out of time for
Wow.
today's show. Can you believe that?
No, and there's so much more we could talk about,
Yeah, we
on
might have to
different
do a
accounts.
part 2
Part
of this
two.
show, taxes and
Yes.
retirement. That's for sure.
Yes.
But
Stay tuned.
Brad, before we go, once again, let our listeners know how they can get a hold of you.
Absolutely. You can call our office directly, toll free, 888-390-5277. Again, that's 888-390-5277, or visit our website, financialarmorshow.com, and learn more about who Cooper Financial is. And feel free to use us, ask questions, and we'll give you all the resources and information at no cost. Or if you want to come in for a free visit over a cup of coffee, we would love to visit with you. And I
All
appreciate all
right.
the listeners who have done that in the past.
Yeah, thank you, Brad. And listeners, thanks for viewing. Thanks for listening. That does it for today's episode of the Financial Armor Show with our host, Brad Cooper.
Thank you, Tony.